Morning, buddy. How are you?
Good. How are you?
I'm good. Just waiting for Jack to join. How was your Easter?
Fun in a weird way. I got the time finally to get into the renos, and now it's all at a point where the plasterer can come through and skim it, and the last room, and we're done. So it feels good, and it was nice to do something that's not all frontal cortex, just tactile, hands, and heaps of time with the kids and board games and all those other things. It was a nice little weekend.
Yeah, I didn't realize he had a builder's license.
Yeah, all works were completed by others.
Yeah, I know what you mean about non-frontal cortex. I think I got like 6 hours on the tractor, and there's nothing like just looking back at a slashed paddock that took no real intellect, but you could actually see the results right in front of you.
Yeah, I'm jelly of the tractor and all of that. We've been watching, the kids and I have been watching Clarkson's farm over again, and the fantasy's running through my head to have a farm.
Yeah, about halfway through, because we ended up with 32 people or 31 people in the end. So it was a fair group and going through a lot of water. But someone said there's a bit of a smell. And I was a little bit sick because the kids are a bit sick. I was like, I can't smell anything. And then as the days went on, hey, there really is a smell. So we started looking around and I thought, well, I'll just check the tank. And I didn't realize there was a second hole in the top. And so when I then poked the torch down to see the dead birds,
Oh,
the dead frogs, even thinking about it right now, I want to spew. Yes, it was feral. So Dom's farm needs a bit of upgrading.
oh, that's not good. At first, I thought you were going to say the septic had gone or something, but that's
I think the septic was in better condition than the water tank.
oh, that is not good. Bloody hell, Jackie boy.
Yes, Jack.
Sorry, guys. Just helping Anna and the kids get out the door.
No, all good. Have you had a haircut?
Cut my hair once or twice a week now. So I think it's going to have to go twice a week because it's starting to get real patchy.
I thought you were about to say it's growing back.
I wish.
How was your Easter, Jack?
Easter was good, just besides the clocks going back. It's Adelaide, so daylight savings ended. So Louis, who normally gets up at 5, has been getting up at 3:30, 4 o'clock. This morning was the same. So I've been walking around the block. He fell asleep in the pram.
That's hard, man.
How good would it be if we could get walked around the block in a pram and just fall asleep?
I know.
All right, well, let's jump in. So, did you see the article that was circulating online and on LinkedIn? I first saw it from Vu Tran doing a post about how AI helped one man and his brother build a $1.8 billion company. It was a New York Times article who said, who needs more than 2 employees when artificial intelligence can do so many corporate tasks? It's super efficient and a little bit lonely. So this is an article by Erin Griffith reporting from Los Angeles, who says that Matthew Gallagher took just 2 months, $20,000 and more than a dozen artificial intelligence tools to get his startup off the ground. From his house in Los Angeles, Mr. Gallagher, 41, used AI to write the code for the software that powers his company, produce the website Coffee, generate the images and the videos for the ads. He created AI systems to analyze his business performance, and then he outsourced the other stuff he couldn't do himself. His startup, Medvi, a telehealth provider of GLP-1 weight loss drugs, got more than 300 customers in its first month. In its first full year of business, the company generated $401 million in sales and is on track to do $1.8 billion revenue this coming year. So the way the sort of article was sort of structured was that we've finally got our 1 or 2 person unicorn.
Yeah, it was interesting. Have you seen some of the commentary though, describing it as a fraud?
Well, if you had read our schedule prior to this, Aaron, the next article.
No, I have not read the schedule, so it's good to know we're going to talk about that.
Yeah. The first one that I saw was Rick Renard said the New York Times just published a glowing profile of a $1.8 billion company, and I want to throw my laptop at the wall. He says it's a cool story, but there are serious concerns circulating that New York Times did not mention. One, there are allegations that the company or partners that they work with built 800 fake doctor Facebook accounts to run flash sale ads for their drugs. They're named in a lawsuit alleging nationwide scheme to manufacture and sell a fraudulent, unapproved oral tripazetide pill. And there are examples being shared of onboarding flows accepting clearly unrealistic inputs. As an example, February 31 as a birthday, or telling that they had a 94% chance of hitting their goal of 200 pounds, starting from 350 pounds and 7'11". Plenty of one-star reviews, undisclosed charges, no refunds, products never delivered, and impossible to cancel. You can decide what you make of it yourself. It looks and smells fishy. And then there was another post, similarly, from Alexander Morales Pantes, who talked about the FDA has actually sent them a warning letter and links it where the FDA has advised that your website and the internet address has observed that it offers compounding drug products. Your website's false or misleading claims concerning the compounded products. And anyway, it lists out a whole lot of different things. So I think there's a slight nuance that, yes, the agentic era is allowing you to build lots of things really fast, but I guess, does it matter if you build it correctly?
Yeah, no, I agree with that. I just think this isn't, when we talk about the 1 to 2 person unicorn company, like I think technology company, not, and when I say technology, I think technology business, not something that's leveraging AI to then sell a product. Equally, this is still a insane outcome for someone to ship $400 million revenue in the first year. Like that is an incredible outcome. But when I go back to, can we see that 1 to 2 person company, that's to me technology. So it's sort of outside of what I think.
Yeah, I think, on the fraud side, we will continue to see technology misused. So I can't say that this is a data point. If it is legitimately fraud, I can't say it's a data point of growth if the transactions actually aren't real or legit. But what I liked on this was actually Vu's post. Like I liked the narrative that Vu had shared this article in the LinkedIn post. And I think his narrative for me really resonated more than the actual story itself.
What was his narrative?
Like he made it kind of ended with, every time technology compresses effort, we don't run out of work, we invent new kinds of it. Like he was talking about from first down to fourth order effects of AI. He led through first order, what happens when a single person builds $1 billion company, and that becomes normal. Second order is then labor starts to look very different, which we'll talk about. Third order is governments have to find new ways to tax value creation. And then fourth order is entirely new industries emerge. And that bit is the unknown. But he's making the point that even every time technology has compressed effort, we've simply ended up with other things to do, doing different work.
Yeah, and the word fraud is thrown around, but I look at a lot of the issues that this is being discussed, and these are the issues of a early stage, young, fast-growing company. It's just that they've all happened very quickly and to a large scale. Like when you have a look at the story of Airwallex, when you have a look at all of these very fast-growing young companies, we've spoken about on the podcast many times, the organizational lifecycle model that doesn't measure revenue or time or number of employees. It's the relationship between flexibility and controllability. And when you build something very young but very fast, that big gap between flexibility and controllability is when you don't yet have the systems to properly handle cancellations. And you're probably a bit over your skis, thinking you're very clever, creating some fake accounts, get up and running, and then it sort of gets larger than you had expected. Like on those instances, like fake accounts, absolutely fraud. And on some of the other things, though, is a company that hasn't yet developed their systems and process. And all AI is going to do, if you build at this speed, you're going to end up with all of those problems mounting upon you faster and faster.
Yeah, totally agree with that. I mean, some of those things about being able to enter a birth date and that, it made me think, well, if tech journalism was as prevalent back when I was releasing software updates to our products, man, it would have been a pretty horrendous journey because shit was buggy. The other thing I think I picked up in the comments as well was just commentary around, like someone gave an example of calling, I think it was the NUSA RSL to book something and how terrible the experience was, but then extrapolating that to, therefore AI will never work. And there's still that sentiment in some of these comments in the threads that, see, look what AI did. This will never work. It's like, these things are not proof of the latter. And so, yeah, it's just interesting to see the commentary around it.
The other interesting point is like this is a competitor to eucalyptus, and it sort of goes back to like big market, small market. And like Tim Doyle, incredible founder, built an incredible business in Australia. But this is just one guy in the US, one of many. And it sort of goes back to like the US and what Vicky Forrest was talking to our cohort when we did the mission recently. Like this is valued at $1.8 billion. And this is a 1 to 2 person company. How many other companies of this size exist in the US?
Yeah. And the 20 VC episode this week is with the CEO of Hims and Hers that have just bought eucalyptus. I highly recommend to listen. I actually feel like buying some Hims and Hers shares. Really good episode. Really like what they were saying and gave a bit of an insight into why they bought eucalyptus.
I saw little pieces of that. I'm going to have to listen. I think back to the other point, Jack, building on what you said, connecting it back to what Don said, big markets also can still reward shitty products. Like this revenue has built to that level despite the product being shitty. And I think that's a good lesson for founders in small markets where we fixate so much on getting the product perfect compared to big markets where you can have, look at Craigslist, you can have a shitty product and still have massive traction.
Yeah, and I think like what these guys got right was the trend. Like this drug was ridiculously good for the market. Like people were seeing such a big change in their weight loss. And I think it was eucalyptus in their first 12 months of shipping this product, they got to $100 million revenue. So it's like there's multiple players here that all got the trend right and all capitalized on it.
Absolutely. Sometimes you just catch the right wave. And that one of the most heartbreaking things in this line of work is when you see really great founders pick shitty waves. And if you pick the right wave, your geniusness can decrease exponentially because it's more about the wave than it is the rider sometimes. Segueing a bit from what you were sort of pointing out, Jack, that there's lots of people that can, in the age of AI, just build companies and you've got competition. There was a post shared to me by Lee Ford of UEF, who notified me of it, that Peter Walker had done a post. VCs care about only one thing, defensibility, moats, so don't bother pitching anything else, his post starts with. He's talking about a post from Jenny Fielding, who had said that. He then goes and puts some data about the one route to defensibility, and he calls it build in the real world. And what this chart is showing is the percentage of funding that is going into hardware-related businesses. And it was actually declining from 2017 down to 2020. And then it flatlined 2021. Then it has started growing and it's gone from 6% to 23%, and it's only continuing. It's something that we had gotten onto fairly early, but it now looks like the data is starting to catch up, that having something connected to the physical world is where that defensibility may lie.
Yeah, I feel like we've talked about this a lot on previous episodes. I think we're also conscious, though, of is that moat, is that defensibility at risk in the future, like with AI? And so it was interesting, Spidey shared some tools that are using AI for hardware product development, at least, but hardware with its switching costs can give good durability. So the other part that I picked up on there, Don, in the commentary from Peter Walker, was just how VCs are shifting now to think about durability, was kind of the vibe of his comment. And I think that's something else that we've been focused on since day dot is, yeah, what's gonna drive durability and ultimately hopefully also give pricing power.
Yeah, and it's all about defensibility. So using that word segue, defence, I saw just a little bulletin in Capital Brief today that Australian defence technology venture capital firm Beaton Zone Venture Partners raised $2.6 million in March as investor interest in the sovereign defence capability surges. The fund reported an acceleration of capital inflows last month, accounting for almost 16% of the total capital raised. The firm raised $10 million in its first 18 months, a further $4.4 million over the following 12 months, and then $2.6 million in March. About $12 million of it comes from external investors, and about $5 million of it comes from Steve Baxter directly. Steve has put some comments in there. And then Vu Tran, who's also an investor, in both this and Black Sky Industries, says, when you consider the geopolitical events of the past 12 months, the thesis has never been clearer. As an investor in Beaten Zone Ventures, it's hard to overstate the value of their early conviction in this space. So it looks like Beaten Zone's getting a little less beaten and getting a bit more traction.
Yeah, this is good to see. I mean, when I last caught up with Steve, which was sometime end of last year, maybe November, December, this is a big jump in the capital they've got since then. So bloody well done. But it doesn't surprise me given the numbers, the companies they had invested in and what Steve was sharing end of last year in terms of those companies' growth and the traction that they'd already had in, at least on paper, valuation lift. And then he was deliberately then going back to investors who had said no, just highlighting how much upside there already was through the fund. So he's done it bloody well and timed it unbelievably well.
He's quite the machine. He doesn't give up.
No, well, we caught up with one of the larger family offices in Australia this week. And yeah, the CEO, the manager was saying he gets calls monthly from Steve, despite the fact that this family office does not invest in funds, but Steve does not stop. And it's a great lesson that despite his exits and everything else, here is someone who hits the phone, hits the pavement, breaks shoe leather and just gets it done.
Yeah, and it's probably worth like highlighting it hasn't been an easy journey trying to get this fund off the ground for Steve. And like for all the founders listening, like it's the same experience. Like there's been 100 no's to the one yes. But for me, like this is just such a constant reminder that a good time to invest is a bad time to raise a fund, vice versa. Like a good time to raise a fund is the bad time to invest. And you look at all the defense companies that are listed, the PE ratios are through the roof. But when Steve was pounding the pavement 2-3 years ago, that wasn't the case. Like if you got in early, you're going to be rewarded now. But now the FOMO, everyone wants to get into defense, where like 3 years ago, it was all ESG. All the stuff that Steve was saying, you've got to believe me, and now it's sort of, the tide's turned.
Yeah, absolutely. But no, it's a good point. Even with Steve's brand from Shark Tank, it has not been easy, but he's kept at it. Changing gears a little bit, I saw this post from Simon Beard that I thought would just be relevant to touch on because I'm seeing this a little bit in the portfolio, but with some other investors. Simon says, in 2015, I spent $1 million on a Magneto site, custom built, devs around the clock, the whole setup. I then threw it in the bin. I moved to a free Shopify site. Everyone thought I was crazy. $1 million in the bin for a free platform. But the tech had changed, and that one decision alone was more than 100 million to me in the end. Here's what I'm watching right now that reminds me of that exact moment. Business owners are sitting on systems that they've spent hundreds of thousands of dollars building, years of development, custom software, internal tools, and they can't let it go. The sunk cost fallacy. You overvalue something because of how much time, effort, and cost you spent on it in the past, but you're not looking at its current value, you're looking backwards. And there's just a couple of situations where even in our portfolio, the right decision has been to actually throw some stuff out and start again and rebuild from the ground up and do it better and make it AI native, AI led. And we see that as just part of the life cycle journey, and as annoying and frustrating and risky as it is, it's just par for the course. Whereas some of the pushback from other investors has been quite interesting, and the vibe is very much around this sunk cost fallacy. Hang on a minute, we spent all of this. Hang on a minute, you've spent all of this time. Hang on a minute, surely it can't be this easy. Actually, with a lot of these tools that are coming out, you have the ability to change your course. And often it starts with just accepting what has gone is gone, and you got to get on with it.
Yeah, it's so true. And it creeps in. This isn't an obvious thing when you're in it, because it manifests as little things like scope creep, or we'll add this in, or we'll keep spending money here to make this work. And then you start looking at not just what's been spent, but cost of transition. And then you end up in a huge tech debt.
We had to do the same with some of our internal systems, and then we've moved on to Airtable. But even there, with what I think we're about to learn with co-work and how things are progressing there, those integrations look really good, but we may have to throw that out as well to sort of create something new. And the big thing is that we're at least giving it a shot rather than waiting for perfection, I think.
Yeah, that's a really good point. It's something that's shifted for me, is even as we're building stuff, looking at it as almost temporal now, because I can see very quickly some of these things we're using like Relay will become redundant when Claude and co-work can do that directly off Airtable.
And I feel a little bit bad. There's an entity that's a bit like us that we're close to and we share notes with, and we had done a lot with Ontraport and a few other integrations, and we'd given them all of how we were doing it and why we thought it worked, and they then went down that same path. And when I was talking to them the other day, they were struggling with a few things. I was like, oh no, we ditched all that. We're out. And I was like, yeah, probably should have let you know maybe, but we found a better way to do it. Yeah.
Wait, John. Well, you can edit this out, but it is.
Yeah.
Oh, fuck. That's shocking.
Was talking to me at dinner at South Star, going on about, oh yeah, we've got this all working on, we've done all this, and I'll have to show you guys so you can do it too. And I'm like, oh buddy, we need to have a convo.
Yeah, this is good. You got to be careful if you're just following. Well, so there's build new technology yourself. There's build your own systems and build your capability out, and then there's buying. And there was an article by Bronwyn Clune called Aquimaxing. A string of startup acquisitions is putting liquidity back on the table for VCs, even as questions linger about lost breakout potential. She says a wave of acquisitions across the startup ecosystem, fueled in part by those fending off the SaaS apocalypse, is delivering returns for VCs who say deals reflect a market working exactly as it should, but questions linger about the long-term potential that is being lost as startups are being absorbed remarkably early. Canberra has been the most active acquirer, and she lists out the various ones that Canberra has acquired. And then safety culture has now moved into acquisition mode after Luke Annear has returned as chief executive, and safety culture has acquired a company called Twine, a Sydney-based AI-powered sales and customer service analytics startup that raised $2.3 million from Airtree and local agents and local angels. So there's a couple of things here. Yes, one of the issues with early exits is that there is an opportunity lost, that you're getting off a rocket before it's got to a point where it's truly a fund returner. But if the founders think it's right to get off and the company thinks it's right to get off, our view is you've got to back the founders and find the next great thing.
Yeah, this has been a topic of conversation. When I was on the board of Startup Oz and looking at Australian founders tend to exit earlier as a general trend than overseas founders. But I think in the current environment, with the level of uncertainty and with the changes in AI and the second and third order effects of that, I think like faster exits, not necessarily smaller, but exits in the near term kind of makes sense. Imagine if Canva had sold in 3 years ago. That would have still had a significant flywheel effect on the ecosystem versus now looking at the markets. When will this IPO happen? What could happen next? Is there an AI threat? Like it's an interesting thing to how that's going to play out. So I have a lot of convos with founders actually about fast track the exit.
Yeah, I agree. I also think it's important for people to unpack a little bit of the whole acquisition process. And we've already spoken earlier in this episode about the life cycle and that relationship between flexibility and controls and predictability. But when an older company is buying a younger company, what you're partly buying is a company that has a much bigger spread between flexibility and controllability, which means it has a lot more issues in there to resolve. But often I see companies not take a life cycle approach. If you take a life cycle approach, you can then be better prepared for what are the likely issues. And what we always suggest is sort of a participative integration council gets set up, not a committee. Committees are all about equality and people having votes, and it's just a nightmare. But a council to be able to counsel the founder or whoever's in charge of doing all these things of what the real issues are is important. And then if you staff it from representatives from both sides, the acquirer and the acquiree, and you give those people an opportunity to raise all of the issues that need to be resolved and all of the challenges that are occurring, and you then set that up as a reoccurring body, fortnightly, monthly, whatever, what you find is your integration of that acquisition becomes much easier because there's a far more collaborative approach. Issues are starting to be raised a lot earlier. They can be prioritized a lot earlier. And there's a lot more people that know what's sort of going on with the whole integration to be able to go back out into the business. Whereas too often integration is done by like an integration lead and it's like done to the company. And that is where a lot of energy and a lot of cultural upheaval can occur versus, hey, let's put some rails to run on and let's integrate this together following a particular methodology. And so it's just going to be interesting to see essentially these young companies, like all of these acquirers are a bit like a teenager going out and acquiring their own infants. Unless there's some very strong structure and some guiding grandparents to be able to manage this effectively, you watch some of these acquisitions can actually cause a lot of long-term problems.
Yeah, or even kill the business. Yeah, it's a good point, Don. I want to give a shout out to Interfinancial, IFL. They have a Insiders M&A event series. It's invite only. You basically have to know the IFL team to get in there, but they will bring in sometimes both sides, like founders on both sides of a transaction post acquisition, and talk through the 18 months of work, like for the deal itself, but also post integration. And it's really kind of like our missions. It's about actually sharing the mistakes, not the successes. For any investors, it's worth knocking on their door, getting to know Sharon and Mark and the team, and get yourself to one of those events. There's one coming up in Brisbane. They're really valuable.
Hey, Aaron, have you been to one of those for IFL?
Yeah, I've been to 2. I think there's one. Just got an invite for another one this morning.
That's awesome. Yeah, far out. That'd actually be really good to see.
It is good because the way Sharon facilitates it and curates the audience, it means they can talk really freely about it. So yeah, it's Mr. Call from South. It's really good.
I know they probably don't, but if they do a stream, can you click me the link? I'd love to dial in.
Yeah, they don't stream and you're not allowed. You're not supposed to share anything from it. But I wonder if they run them. I'll see. Yeah, I'll see.
Yeah, cool. Oh, that's good to hear. That's cool to hear.
Yeah, so that's it for the content piece for the week. But theme of the week, Jack, have you got something?
Wait, can you go first, Aaron?
My theme of the week is reflecting on what part of the brain are you operating from, which I just noticed this week, I'm very much in my frontal cortex and I don't normally think in words, but this week, just a lot of dialogue and just how taxing that is. And I don't do my best work in that headspace. And so it was a reminder for me of being cognizant of using the tools to get myself back into the right mode of action and realizing that I've actually dropped that as a habit because I've been feeling reasonably good and not in need of it as much, but just reflecting on the fact that I know this toolkit of habits and routines that really work for me to get me into a particular mode of action and get my mind where it's kind of like driving down the highway where you're driving subconsciously so that the rest of your brain can think about something else. And I need to get back into that state. So for me, just a healthy reminder of being really cognizant of our mind in terms of our thoughts and which part of the brain we're operating from, and making sure that we are deliberately taking actions to engineer that. And so that's my theme of this week, is getting that right again.
Yeah, I like it, Aaron. I don't really have like one exact theme, but I would say like this week, it just feels really good. Like the quarter's ended. I feel like I'm finally on top of things. And I don't know if it's just because I'm back full time or it's just, we've just got like a good rhythm and good operating system at the moment, but it just feels really good when everything's in flow and like, you just know what the next things, like the things you've got to do next, and you're not a month, 2 months behind.
Yeah, that's really good. I have noticed, I think the combo of you back full time, Pat really coming up to speed, a lot of our automations, and just feeling like we're actually chewing ahead on stuff. But I still have this long list of administrative tasks that I feel like I dropped the ball on. And I feel like I've dropped the ball on relationships. Like I need to be more proactive in outreach. Yeah,
I think there's always going to be admin tasks that like we're never always going to get them all done. Like it's just the reality of running a business. But yeah, it's definitely like we're definitely in a good cadence at the moment. Don, can you hear us yet?
In the rare moment in our podcast history where Don is unable to use his microphone, we should make up the theme of the week for him.
All right, I'm back. I'm not sure what's happening with my internet. I could hear you guys. Jack, I did ask if you feel that you're all back on top of things. The question I had was, are you just delusional?
I'd love to say you're a sauna, but then you'd ask me what's a sauna. So
Oh, good call.
That is true. Yeah, I think the theme for me this week was, especially with the accelerator and the missions and the government support that we have, is just the need for repetition and to reach out and to, when you think people really understand what it is you do and why you do it and how you do it, they're so busy with a lot of their other stuff that even if they did know at a point in time, they've probably forgotten. So the need to actually continue to remind and to connect, and that comes back to that relationship bit, Baron. So totally on board with that one with you. So what are we looking forward to?
I've got an event. I've got to jump in on the Bike Owning the Precinct for Raising Capital in 2026 panel event. So I'm looking forward to being part of that. So from 10:13, we'll be there and a couple of others. So should be a good one.
I'm looking forward to going to the AFL tonight for an Invest SA event, and then birthday tomorrow, so 27 tomorrow, and then
Woohoo!
Saturday playing rugby, and then going out for a few beers.
27. You've now flipped into late 20s.
Yeah.
That's awesome. All right, well, some quick shots. This is the picture of Anthropic's annualized revenue run rate, which has just been announced at 30 billion, which makes their capital raise early this year and late last year look very, very cheap. And this is where we come back to valuation, right? For the right deals, everything feels expensive, but if it's got the right momentum, and I think Anthropic is going to wipe the floor with OpenAI. I think OpenAI and Sam, for all of his ingratiating tone and the way he talks and speaks and whatever else, I think strategically they've just been unfocused and they've tried to do too much and they've tried to be all things to too many people, whereas Anthropic have really just concentrated on a particular niche. And I think they're going to get rewarded. This is the World Uncertainty Index that is put together by someone on the bottom of the screen, but I can't actually read it because, Jack, when you get to 43 and you forget your glasses, you've got no idea what's happening. But anyway, this goes back to like 1990 and we are at record levels, which makes sense. Given what's happening at the moment, I can well imagine why that global uncertainty index would be at a record high. Now, in terms of this is the S&P 500. This is going back only to 2023, but by the dip, this is a chart that just shows the last 6 times or 5 times when volume has spiked just on a low inflection point above nearly the 1.5 trillion, that has signaled to the market starting to rally. Now, remember last week I said I made $350? Yesterday I made 3,000. Not because I did anything, but again, I was in the caravan, not yesterday, day before. I just had a feeling that Taco Trumpy was going to do his normal thing. And so I'm in the caravan very early in the morning before the market and I just couldn't see shit. So I wanted to buy 3 contracts and I bought 30. And they were like SPY contracts out of the money expiring in like 5 days. And so it didn't cost me a huge amount, but then we just had today this massive jump. So yeah, that's not intelligence. That's just absolute stupidity. So
yes, but you've got to be in it to win it. So well done.
Yeah, but because they're ill-gotten gains, not through competence, it means I will give them back. That's how the market gods work. I'll get all arrogant and fool myself and go and buy some stupid stuff and just hand it all back. So now, that's one person using a chart to say, hey, we're about to go up, but you can always find the opposite. So it's this guy, Ted Pillows, he has plotted the S&P 500 and the MOVE index. And the MOVE index, which is inverted, has obviously, so the MOVE index is bond volatility. And when you invert that and then put that along the S&P, for 2025, it's been marching in step with bond volatility, and bond volatility is going through the roof, but the market hasn't fallen by the same amount. So he's saying we've got a lot more to run on this dip. But yesterday's price action probably disconfirms that. This is a chart, a historical concentration at peaks. So this is going back to the Nifty 50, the 70s, Japan in the 80s, tech in the 2000s, and AI in the 2020s. And when the percentage of the S&P 500 is in the particular concentration area, so in this instance, it's AI, previously it's peaked at 40%, 44%, 41%, and we're now at 41%. Now, history's never exact, but if this percentage of S&P 500 holds out, we're getting pretty close to the peak potentially. But with AI, you could expect it to blow out of the water. This is a chart of the world happiness rankings. And if you have a look at like Finland, Iceland, Denmark, Costa Rica, Sweden, Norway, they're pretty stable in their happiness from 2018. Australia was fairly stable, but since 24, we've shit the bed a little bit and we've really diverged from New Zealand. But US, Canada, and Britain, they're some of the most unhappy people. And I think I feel that. I think Australia in the last couple of years has really become a less happy place with high inflation and high property prices. Watch this space. This is a chart of open AI investors and their return multiple at an $852 billion valuation. The early angels are up 240 times. Is it 240? Oh, fuck, I can't read that. Hang on. Let's try and make it bigger.
140.
140, is it? But guess who? So I didn't realize that Ashton Kutcher, who is actually quite a good venture investor, he's second at 43 times his money. He, Coastal Ventures 30 times, Microsoft 18 times, Thrive Capital 4.8 times. So there's still people doing good. But I'll talk about a pivot going from actor to VC, old Aston. This is a chart, data going back to 2000 for, I think this is the census, but this is the number of people that are officially Catholic in the US, and that's been falling like a stone. But have a look at since 2020. It's venture-like returns of people returning to Catholicism. So I wonder what Catholicism is answering that the rest of the world can't. And that is it. Now, a great friend of the show, Adrian Bunter, has put together a little song that I'm going to use for the outro. So what he did was he took the R&D report from the government and ran it through Gemini for a bit of a review, and then he asked it to turn it into a rap song. And so this is Gemini's rap song that he then threw into Suno with a few prompts to actually create this song. So for the listening pleasure at home, I personally think it's great that people are getting on the bandwagon of turning things into music because everything's just a bit too serious these days. So I'll play this out for you. But good to see you, lads. We'll catch you in the meetings.
Sounds good. Thanks, team.
Yeah. Crossroads. Time to wake up. No more relying on luck. Let's go. We standing at the crossroads, the lucky streak is stalling. Look at the R&D, the global rate is falling. The lucky country myth, man, that story's getting old. It's a once in a generation chance to be bold. We peeling off the band-aids, fixing up the core. Can't just dig it from the dirt and ship it out the door. We need the elevation, need to elevate the state, shift the whole trajectory and engineer our fate.
Yeah, we stepping up the game, no time to pretend. This is the defining decade, let the future begin.
Ambitious Australia, yeah, we playing to win. Start the flywheel moving, let the future begin. From the labs to the market, bringing out the light, scaling up the vision on the 6 pillars of might. Yeah, standard of a living is the ultimate prize. Ambitious Australia, it's time to rise. Yeah.
Check the 6 pillars, we building the foundation. Health and the medical, healing up the nation. Agriculture, food, keeping everybody fed. Defense and the energy, staying miles ahead. Resources, technology, the center of the plan. Solving national challenges like only we can. High risk, high impact, yeah, we making the pact. Keep the promise intact, that's a certified fact.
Ambitious Australia, yeah, we playing to win. Start the flywheel moving, let the future begin. From the labs to the market, bringing out the light, scaling up the vision on the 6 pillars of might. Yeah, standard of living is the ultimate prize. Ambitious Australia, it's time to rise.
Unlock the super funds, bring the angel gold. Talent is the power, let the breakthroughs unfold. Industry PhD, stepping up to the plate. First nation expertise, yeah, we making it great. We need a front door for the dreamers to explore. Punching way above our weight, we ain't settling for less no more. Government leading the way, setting setting up the base, procuring innovation, putting capital in place, securing sovereignty. Yeah, we building the ground, a narrative of success that the world's gonna sound inclusive and free. Yeah, we setting the standard. Ambitious Australia, exactly what we demanded.